adoptada en esta reunión de 2 días que finaliza hoy de política monetaria de la Reserva Federal. Mientras tanto, nosotros no perdemos el foco de la mirada internacional y vamos a ver cuál es la expectativa que baraja en estos instantes Jay Pelosky, founder at TPW Advisory. Jay, good afternoon. How are you?
Hi, Marta. Nice to speak with you again. I'm fine. How are you?
Well, we have the main focus today in the Federal Reserve. We can't avoid it. Do you think Powell will slow the pace of rate hikes by the end of this year?
I do, and I think more importantly than what Jay Pelosky thinks is kind of what the market thinks, and clearly the market is pricing in a little bit of a slowdown from 75 basis points today, which is pretty much a given, to 50 basis points in December, though the odds of that are still kind of up in the air. But I think the direction of travel is for a step down. That seems to be the new phrase, a step down from 75 to 50, and then another step down from 50 to 25 as we enter 2023. But I think importantly, that's, the market has now priced in the Fed path to a terminal rate of 5%. And I think, therefore, we hopefully are getting to a point where the Fed is going to become a little less important to the market than it has been over the last, let's say, 6 months, 9 months, when it's been pretty much driving the entire train.
All of this is really important because we are seeing a worsening outlook from the US economy. Last manufacturing index from the ISM, we have talked now with its chief, with Timothy Fiore, showed an industry needing the stagnation. Talking about Jerome Powell today, whether you see the limit of these rate hikes, where do you think the Fed will stop these increases at 5% next year?
Right. I think that's the market consensus at this point. We've gone all the way to pricing a 5% terminal rate in the Fed fund rate by early next year, and then beginning a slight reduction or interest rate cuts at the end of the year. And so I think that latter part about cuts remains to be seen. But I think given our expectation at TPW Advisory for continued evidence, not just signs, but evidence that inflation is rolling over, some of that was just discussed with Timothy in the ISM report, but evidence that inflation is rolling over should be supportive of that terminal rate, and that should then allow for volatility in the Treasury market to start to decline. And that's really what's important for all assets, not just bonds, but also stocks and currencies, is to see some of the macro volatility stabilize. And I think we're again kind of at that point where we should be starting to see some of that stabilization.
Meanwhile, if we look at the labor market in the US, we today have the data of the ADP, 239,000 private payrolls the last month, and we are expecting the employment data this Friday. What can we expect about that, and what do you think about the data we've known today?
Well, again, Martha, I think the evidence is pretty clear that the job market is slowing and softening from, we were running at a pace of 500,000 new jobs at the turn of the year, down to 350,000 or so by the middle of the year, and now down to somewhere around 200,000. I think that's the consensus for Bloomberg consensus for Friday, is about 200,000 new jobs. So clearly, the job market is cooling off. If you look at quits rates, which is something we focus on, and I believe we've discussed before with Negocios, that is clearly rolling over. In other words, people are not as confident about getting another job, so they're not quitting as much. And that's kind of the leading edge of the job market, one of the signals we look at. So the data is, again, the evidence, the data is starting to pile up in favor of what the Fed wants to see, which is a cooling job market. And I do think what's interesting is that there's a lot of discussion starting to bubble up about the good nature of a strong and solid job market where people are employed and are working. And, does the Fed really want to crush that job market? And I think this debate is something that we're going to see much more of in the course of the next couple of quarters. The debate between 3% inflation versus 2% and 4% unemployment versus 5 or 6%. I think those are the parameters that we're going to start to discuss once it's clear that the evidence is in that inflation is not running out of control and that we're not going to have a wage price spiral. And so far, again, certainly on the wage price spiral, there's no evidence of that in the US, nor is there evidence really of that even in Europe, where, as we know, inflation is running at double digits.
An interesting debate indeed. Meanwhile, we are seeing the evolution of these midterm elections around the corner. Democratic Party is expected to lose control of the House of Representatives. According to the last poll that published Reuters and Ipsos, what do you think about how could markets react next week? Have markets priced in this scenario of Joe Biden losing power?
Well, I think it is typically the case, Martha, that the party who controls the White House loses seats in Congress during the midterm elections. So that's not really a surprise. I mean, what's kind of been going through the market is the history, which shows that every year after a midterm election, going back to 1950, the next year is a positive year for the S&P. So it has an unbroken record of every year following the midterms that the S&P is up the following year. So, and it's regardless of party. Doesn't matter whether the Democrats or Republicans control the White House or the Congress. The point is that the market feels like that's a piece of uncertainty that's removed and historically tends to do better. And part of it is also that the market likes gridlock so that it doesn't have to really focus too much on politics. It can focus on earnings. It can focus on company results. It can focus on economic activity. But I think more important than exactly how the breakdown comes out after next Tuesday's elections is the history, which suggests that the following year is a positive one for stocks. And I think that, coupled with this idea that we've priced in all of the Fed tightening to a 5% terminal rate, priced in with that debate about very solid job market versus the cost of driving inflation at 2%. I think all these things are starting to coalesce to support the idea that maybe markets are bottoming and the upside might actually start to look a little bit more appealing than the downside. At least that's the view from here at TPW Advisory.
And finally, Jay, rumors about changes in the zero COVID policy in China are increasing. It's a mysterious screenshot that spurred a rally because we've seen how an unverified post claimed top officials are mulling a reopening plan. If that's true, that we don't know for sure, what could it mean for markets?
Well, it'd certainly be good news for the Chinese equity market and currency market, both of which have been, underperforming significantly this year, particularly the equity market, which we know because we've been one of the groups that have been more positive on China this year. That's been wrong. That's been a mistake. It hasn't worked. But I think at this point, Chinese equities are very, very attractively priced, very cheap. And so the framework is set for some positive news. And I think that it's not a surprise if there are plans going on to maybe move away from draconian zero COVID of the Shanghai type 2-month lockdowns. I think we've already done that. The last big city to lock down was Chengdu about a month and a half ago, and it was only locked down for 2 weeks. So we've already moved away. I don't think we're going to see again the 2-month type lockdown that we saw with Shanghai in the spring. I think we're moving to some kind of more mixed use model where things are done in a more specific fashion for shorter time periods. And that's really the expectation I think the market has. Clearly, if there's a report released or some government imprimatur saying that we're going to move off of zero COVID, risk assets in China will go up dramatically, and probably around the world go up dramatically, because China is obviously a very big, important part of the global growth story. And for us, the point with China is that it is already kind of desynchronized from the slowdowns that we're seeing in Europe and the US. The Chinese economy is recovering from the very low growth path in the first half of the year because of the COVID lockdowns. And we expect that to continue with some policy measures that should be manifesting themselves over the next couple of months. So we remain constructive on China, and think at this point, given valuations in particular and kind of sentiment, it would be a mistake to be too negative on China.
Jay Pelosky, thank you so much for having us this few minutes. A pleasure.
Great, Marta. Thank you. Bye-bye.
Y nosotros ponemos en estos momentos el foco también en la noticia SG del día.